All right, welcome back to another topic in creative financing. There are a lot of opportunities for creative financing, so keep that in mind when you're shopping for homes if you need them. So, the next topic that we're going to discuss is called assumable mortgages. So, what is an assumable mortgage? The easiest way to explain it is this: you are buying a house from a seller. The seller still has a mortgage on the property. When you're going to buy that house, ordinarily, the proceeds from that sale are going to go to pay off that seller's mortgage. And whatever's left over from all of the liens that they have on that house, they get to keep, right? That's their profit, if you will. Well, in a situation where a seller has an assumable mortgage, that means if they are selling you the house, they can also assign you as the new payer of that mortgage so that you take over the loan for them. And then whatever was above that, they get to keep that as profit. So it still is the same thing as far as they're concerned. But the benefit to you is that you get their loan. And you're only going to want to do this because the assumption is that when you assume their loan, the interest on their loan is going to be much lower than what your new loan would be for the same amount of money. So, for example, if you are buying a house from a seller for $300,000 and they had recently refinanced or they just recently purchased the property, and so they've paid off their mortgage a little bit, but they still have $250,000 left on their mortgage. They want to now sell it for $300,000, but they have an assumable loan. You can now take over their loan for $250,000. And the benefit to you is because if you are going to buy this property, you are going to take out a loan for, let's say, $260,000. And you are going to be hit with 7% interest. But they just bought this house a few years ago. Let's say it was during COVID, and they have a $250,000 loan for 3% interest. So wouldn't it be a lot better to take the $250,000 loan at 3% than a 260 or even a $200,000 loan at 7% interest? Of course it would. So you're going to assume their loan and then figure out a way to pay the difference, the other $50,000. Either you'll pay cash or maybe you'll get a second loan for that. But what you're going to try to do is get that assumption done for their loan, so you start paying over those payments and they still get the $300,000, which is all they cared about in the first place. And that's it. It's as simple as that. The problem really is that not every loan is assumable. So the only way this works is if the seller you're buying the property from actually has an assumable loan. And you would know this because inside their loan documents, there's a clause that says that this loan is assumable or this loan is not. And so if it's assumable, it's a great thing to look at. And if the interest rate is lower, which oftentimes it would be, especially nowadays, then it's a great opportunity. And the only thing that you have to do is add one document into the mix of your purchase agreement. And that is the assumed financing addendum. It's very straightforward. It's only one page long. And all it says is that you are obtaining the loan from them, and buyer's approval. Your buyer has to be approved for that loan still. And it's part of a contingency on the agreement. And that seller has to, within 5 days after the acceptance of the agreement, request from the lender copies of all applicable notes of the deed of trust and the loan balances and all of that stuff. And that within 17 days after acceptance, and again, you can change these timelines based on the agreement you have with the seller, buyer shall, as specified in the agreement, remove this contingency. It's the same as the loan contingency that we had before. And if you don't get the documents from the seller, within 7 days after acceptance, then buyer has 5 days or however many after receipt of those documents to remove those contingencies. So this is like any other contingency, just like the inspection. If you don't get the documents from the seller within the certain amount of time that they were supposed to give it to you, you have an extra 5 days from within the time that you did receive the documents to then cancel those contingencies. It's very straightforward, and easy to follow. You have option B here, is that if you check this, the loan contingency is in effect until the lender approves that assumption. So you can't just take over the loan, right? Obviously, the lender is going to want to have some say as to the risk of who's going to be paying it back, but they have to therefore approve you as well. So you can extend that contingency until the lender approves you. So that's what an assumable mortgage is, and the form that it goes with. It's a great opportunity if the seller that you're buying it from has that assumptive clause in it. And you may do this after you actually get into contract. So you may not know about the assumption until you're actually in contract, which is fine. You just add that AFA as an addendum to the contract and you're good to go. Hope that helps, and see you when we talk about seller financing in the next topic.